protecting Main Street from Wall Street. It's time for Money Unleashed with Eric Johnson and Kyle Allyn.
You have to have a plan where you know if the market's going to go up, what happens next. And you also have to have a plan where if it doesn't go the way you think, you know what you're going to do.
It's time to put you back in control of your money.
I'm not trying to predict the weather, which is kind of what we're talking about, right? It's predicting the stock market. I'm trying to build a better boat.
This is Money Unleashed with Eric Johnson and Kyle Allyn.
Welcome to the Money Unleashed podcast. I'm Eric Johnson, joined as always by Kyle Allyn, and we are the vice presidents of Hoffman Financial Group. We bring you new episodes every Monday and Friday, so be sure to subscribe wherever you get your podcasts. Kyle, what we're going to talk about now is one of my favorite forecasts, and that's the forecast of Mr. Tom Lee. He is the manager of FundStrat, and he used to work at JP Morgan a long time ago. And he's saying 6,600 for the S&P 500. For everybody, this week it's been teeter-tottering around 6,000. And by the way, the S&P 500, which is what most professionals are looking at as far as figuring out what's going on with the stock market, we're basically in the green again for the year, right? So we have the tariff tantrums. It's popped back up. It appears that we've recovered. The consumer's been amazing. Retail investors have been investing. Professionals are starting to dump back in again. And Tom's one of my favorite analysts because he's always a bull, and so am I. But he says, hey, the full year target is still a reasonable expectation, and businesses are in a better place now than they were back in February, which I would argue is true. He also had another quote the other day saying, well, because of the dip, because of the tariffs, that has created a new rebirth for another bull market, which I also agree with. And it's my opinion, and we're going to see S&P 500 between 64 and 6,600, like Mr. Lee says so. But that's a big deal for people who are trying to retire here shortly, isn't it?
It is, and it's really exciting to hear him say something like this, to hear the market's going to go up another 5%, 10%, big numbers, right? So I'm kind of in your camp. I'm generally pretty bullish, generally pretty optimistic, but I do talk about this on the show sometimes, which is, and I talked about this last night at a workshop I was doing, I don't really care where the market's going next. I believe in the system. I believe in the American economy. I believe in American exceptionalism. I don't think in 5 years or 10 years, you're going to look back and say, well, I should have put my money into Thailand. I should have put my money into Europe. I think you need to be here. I think this is the place that has the venture capital. This is the place that has the human capital. This is the place that has all the different little mechanisms to ultimately move the economy forward. So for me, I'm excited to hear Tom say this. He's generally a bull, so it's exciting when the bulls like Tom come out. It's exciting when the stock market makes money. Of course, I get paid in the stock market, so one of the jokes I make with the clients is the sun's shining and the market's up, so I'm in a good mood.
That's right.
But I want to say this on the other side. To me, the problem is a lot of people get left behind.
Yeah.
A lot of our clients are going to be 50 and older, and a lot of times people that are moving into their 60s, moving into their 70s, are sitting down with an advisor and they're being told that they need to get out of stocks.
Yeah, that's a problem.
That's right. And so the discussion is, how much should you have in stocks? It's an allocation question. I believe everyone should have stocks in some amount or in some capacity. Now, some people say, I don't want to have stocks directly in the stock market, so maybe we'll use a hedged mutual fund that has some options protection. That way, if the market goes down, you've got a little bit of protection on it. Maybe somebody's using a structured note that's connected to the marketplace, and it's ultimately able to run different levels of return there. Maybe they're using something like an insurance product, like a fixed index annuity that is connected to the market. It's not going to get market gains, but it may get some market exposure. So I believe that even someone in their 80s should have connection into equities, and I believe that because one of the biggest financial risks in retirement is longevity.
Right, and the reason why Kyle's saying that, everybody, is, and I believe the same thing, everybody should have some equity exposure in retirement. Now, the goal for this money is not to be money that you absolutely need to have touched, right? Like, you want these equities in your, or stocks, if you will, in your portfolio to keep up with inflation, because inflation's real. It's not transitory. Transitory just means temporary. That was like one of my least favorite things that happened a few years ago, is when they started saying, oh, inflation's transitory. Look up the word. It just means temporary. Just say the word temporary. That's not true. So it's going to be around in some way, shape, or form. Now, the good news is that inflation's kind of ticking back down, which is a good thing. There's a possibility it can go back up, but the way you stay ahead of that is with growth. And the biggest problems that you and I are seeing are that we're getting people well into retirement being told, you're not allowed to have Amazon in your portfolio. You're not allowed to have NVIDIA in your portfolio. You're not allowed to have Apple or these other mega cap tech hyperscalers that are driving the markets up. And you should have those in your portfolio. But the difference is you shouldn't have all of your money in those types of positions, right?
That's right. So one of the things I saw that was kind of interesting, the average lifespan has increased from about 68 years in 1950 to 78.4 years in 2023. So according to the Center for Disease Control and Prevention, the number of 100-year-olds in the U.S. is expected to quadruple over the next 3 decades. So we're basically saying people are living longer.
Yeah, which means your money's got to last longer.
Exactly. So what is the driving force behind your portfolio? We talked about it in the last segment. A lot of people are coming in accepting 7% return. Well, what if we could get you 2% more? One of the things we do sometimes on the show is we talk about the differences that can be created in these investment returns. So let's say somebody comes into our office and they've got $200,000 that's off to the side that's able to grow. Now, I want to be clear about this. I operate on the bucket design, the bucket idea, and so you've got some money that is ready to pay your bills and keep you out of thinking about the market.
Yep.
So that first bucket, let's say it's got $400,000 in it, and that's what you're going to pay yourself from. But what I'm talking about here is your growth bucket. So off to the side for that client, they've got $400 on the side, invested in good things that are making 5, 6, 7% return, and that money will pay them. But this is the fun bucket. This is the $200,000 that they've invested for the future. Let's just say that they were looking at it from a 15-year standpoint. So we're saying that the original bucket, the income bucket, can pay the bills, and then this bucket is able to sit out into the marketplace. If that client comes in and mirrors that bucket similar to their slow bucket at 6% return, their investment is around $480,000. If they just moved it up 3%, 6% up to 9% return, we go from $480 to $730.
That's a big deal.
And if you can push that to what I would argue you should be, which is a market type rate, around 12%, we're over $1 million. You're getting close to $1.1 million. So the difference in just a few key points, we're not talking about making 60% return here. We're not talking about some astronomical number. We're saying that a lot of times people are coming in and their growth bucket is making the same return as their safe bucket. And if we could get that growth bucket to move, it might double. In this case, we're talking about possibly even tripling.
Yeah, and here's another thing you want to think about. So whenever I set up an income plan for people, it's got 3 different ways you can pay you every single year. So obviously we talked about the income bucket where we're retaining our principal and we're sending you money every single month to supplement pensions and Social Securities. That's the most important one because just like you said, that's the one that gets people to stop watching the news and understand that they're getting paid, right? You beat the time component. But then we also got the growth bucket that we're talking about, and that's important because that's money we can take out whenever we want, right? So you've got, I like to pay people 3 different ways. Once every month, which satisfies everything and flood you with income. Then you've got money that's off to the market. You could take the gains every year and go on a vacation. You could take the gains every year and buy a car. You can trim those gains every single year and do something fun with it and still keep it, in the market to grow. And then you've got another defensive side that normally we like to pay people once a year on. And now you got once a year we can pay you, every month we can pay you, and whenever we want we can pay you. And then you touched on something that's very important. If you just bumped up your aggressive money by 3%, that changes the growth rate tremendously. What if you did the same thing with your defensive money? That's also a possibility. You don't have to be stuck making 1.2% in a bond fund. You alluded to a couple different vehicles that we have that can get you, north of, anywhere between 4 and 6 or 7% very safely. And that also increases the trajectory of your growth plan as well in retirement. And that's what people don't understand is that when they come in here, Kyle, I think the biggest fear that they have is running out of money, wouldn't you say?
Absolutely. And I think one of the things that you talk about a lot, I've adopted in my practice when I'm talking to people, if you can get the safe money to work,
yes,
if you can get the safe money to make more money, then you've got room on the other side with the growth money to put it in the things that we know we want to be in. The unfortunate thing about investments, stocks like Apple or Amazon or on and on and on, would be their volatility, meaning they're going to move up and down, they're going to take losses, but over longer periods of time, these companies are ultimately illustrating the ability to change the world. So if you can build an income bucket that's running higher levels of return with better levels of yield and distribution, then you get more time, more ability to buy those things that we believe in 5 years, 10 years, 15 years, we'll see massive accumulation.
That's right, Kyle. I think the longevity risk is what people are scared of. They're scared of going to zero, right? That they're going to live to 100 and their money's going to go to zero. They've got no way to make it back and they're just stuck spending Social Security the rest of their lives. When you set up a proper plan, that is a risk that or a fear, I would say, that you don't have to have anymore, where you're going to be able to leave a legacy to your family if you wish. You are going to be able to use your money and still grow it in retirement. And you have to have a proper plan in order to do that. We talk about the 5 Ps. We talked about it already a couple times today. It's proper planning prevents a poor performance. And typically, if you're using the Wall Street model of stocks, bonds, and mutual funds, that type of plan is going to seem rather impossible. And the only real true way to get yourself the clarity and the proper planning is to have someone look at it and set one of these plans up for you. And I got to tell you, I would say half of my clients are already shoved off a dock on the income plan and retired already. These are the most happy, carefree people. I mean, I'll do a Food Friends Finance seminar just to update them what's going on, and they are just over the moon. They're smiling. They're having a glass of wine because they don't have to worry about their money, and that's the type of plan you want in retirement.
That's right. When we went through the tariff tantrum, as you called it, I didn't have any phone calls. You want to be in a position where you can see volatility in the stock market, you can see change in Washington, and ignore it. Go back to the pickleball court. Go back to the golf course. Go back to playing with the kids. My son, when he was little, our neighbor was a retired guy, and he had what we called a golf cart.
A golf cart.
Right?
Okay.
Or a golf cart, right?
Okay.
So get on the golf cart, have a little fun, relax. And so that's what retirement's supposed to be about, not stressing out about the next administration or the current administration or the stock market or running out of money. That is the entire reason we exist as a company. We come in, we hold your hand, we navigate you through, and as I talk about at my workshops, the way to quell the emotion is with logic and then the repetition of that discussion. So we'll give you the logic, we'll give you the clarity so you can understand where your portfolio's at, the income that you're going to get, the tax consequences, the choice on the Social Security. We'll wrap it all up in a nice bow for you, and then we'll continually meet with you on a quarterly basis to show you, okay, where are we at on this plan? How are we doing? And in every market, I tell people often, red team, blue team, I'm the green team.
That's right. And don't forget the guidance. There's a lot of different ways. I mean, obviously we do this radio show where we get to talk about what's going on and tell people what's on our mind, but we also do a monthly podcast where we talk about what just happened this month, and we include all of our clients. They can join, and I can give you my 2 cents of what's happening and what I see coming in the future. That's also big, along with the quarterly meetings. So the communication's there, and we're constantly trying to get our thoughts and feelings out to people so they're not losing their mind. So I'm glad you didn't get any phone calls. I got a few, right? I mean, it just happens when the market goes a little wonky. And it wasn't for the retired folks that we're dealing with. It's the people getting ready for retirement. I really feel for the folks who wanted to retire, in the first quarter of this year. They might have to work a little bit longer. They might have to draw down some cash if they already did retire. And that's a tough spot to be. And yes, you do expect phone calls from those folks, but those are the people who need the most attention, right? And if they have a proper plan put into place, yeah, you're going to see your fund bucket probably go down a little bit more. But if the remainder of your money is solid and coming in, that's what gives you the confidence and the clarity to understand that, okay, all things will pass. This is just policy change. This is going to fix itself in one way, shape, or form before the end of the year, and you're back at it. So I like to tell everybody out there that having this type of plan is super critical. Like, you do not want a red day to be a bad day and a green day to be a good day in retirement. Let's put one of these together for you so you can actually enjoy your retirement, go outside and get some fresh air and not be attached to the television screen scared watching the news giving you nothing but fear. 404-640-5511. That's 404-640-5511. Or you can find us online at unleashyourmoney.com.
Eric Johnson and Kyle Allyn are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor and affiliate of Brookstone Capital Management, LLC. BWA and Hoffman Financial Group are affiliated under common ownership. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosures of any conflicts of interest. Please refer to our firm brochure, the ADV2A, page 4, for additional information. The Hoffman Financial Group and WSB are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. This information should not be considered tax or legal advice. Individuals should consult with a professional specializing in the field of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Any client experiences discussed during the show are unique to that client. They are not meant to imply or suggest you will experience the same results. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone. Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Please refer to our firm brochure, the ADV2A Item 4, for additional information. Hoffman Financial Group is not affiliated with or endorsed by the Social Security Administration or any other government agency. Insurance licensed in Georgia, number 163546.